Ladies and gentlemen, welcome to our exciting and informative webinar designed to make your investing journey a little less puzzling. This episode is brought to you as part of the Investor Education and Awareness Initiative by Mirae Asset Mutual Fund. I am Meghna Maiti, Assistant Editor with Outlook Money and your host for this session. And today we have an exciting topic to discuss. All you need to know about factor investing. In the dynamic world of investing, fund houses are offering diverse and innovative product solutions to investors to keep pace with the changing demands and trends. Factor investing is among the latest trends. Today, we aim to shed light on the intricacies of factor investing. To guide us through this insightful session today, we have with us Mr. Siddharth Srivastava. He is the head of passive investments, Mirae Asset Mutual Fund. And let me give you a short introduction of Mr. Siddharth Srivastava. He has over 12 years of experience in the field of financial services and stock markets. He has been associated with Mirae Asset Investment Managers, India Private Limited since 2020, with overall responsibilities of leading passive investment products. So welcome, Mr. Siddharth. This webinar is curated with an aim to provide clarity on all aspects of factor investing. And we assure you that by the end of this webinar, you will be equipped with the knowledge about factor investing. So let's unravel the world of factor investing. Over to you, Siddharth. If you could please help our viewers understand what factor investing is.
Okay, so I'll answer this in very detail. The investing world started with active investing. So what is active investing? Active investing is fund manager identifying stocks and sectors which he like, and he or she invest in those stocks, right? And you have all these active mutual funds which are run in that manner. So a fund manager may like A stock more than B stock and pick A stock to become as part of his or her portfolio. Now this is started and is happening now and will happen in the future. Now somewhere in last century, we also started talking about passive investing,
Right.
which is basically investing in the portfolio of an underlying stocks. So for example, a large cap active fund picks up large cap stocks, which the fund manager likes because of growth prospects, underpricing, etc., and makes it part of his or her portfolio. Whereas, let's say a passive fund, let's say a Nifty 50 ETF or a Nifty 100 ETF or a Nifty 50 index fund or a Nifty 100 index fund, picks up all the stocks of the underlying portfolio. So a Nifty 50 ETF will pick up, invest in all the underlying 50 stocks in a similar manner, in a similar proportion as they are present in the index. So there is no call which is happening or no fund manager call which is being taken to exclude a certain stock or add a certain stock. So in case of passive fund, you will get returns which is equivalent or similar to the returns generated by the underlying index. Whereas in case of active funds, a fund manager, because of his stock picking, basis of his calls, will generate return based on his or her underlying portfolio. Now, what happened that people like you, Meghna, thought that passive investing is simple, right? And it always picks up stock based on the market cap. So what is Nifty 50? Nifty 50 is that you're picking top 50 companies which are listed on National Stock Exchange. What is Nifty 100? You're picking top 100 stocks. What is Nifty Bank? You're picking top 12 banking companies which are listed on National Stock Exchange. So all the stock picking was happening on the basis of market cap.
Right.
And hence the exposure of passive funds was always towards larger market cap based companies typically, right? Within a sector or within a large cap segment, or if you're investing in, let's say, S&P 500, whatever.
Right.
Now, people said that why not we identify certain behaviors or certain factors and try to create a fund which gives me that behavior. Now, this sounds very complicated. It is not. So, what are these behaviors? So, people, that's what they thought and realized that in active fund or active management, certain behaviors are targeted. For example, uh, momentum. A lot of fund managers actually pick stocks based on momentum. Whichever stock is doing well will probably do well in near future, right? They pick up stocks based on quality. Whichever stock has a lower leverage, higher profit stability, and higher return on equity gets picked. Then
Right.
they also pick stocks based on less volatility. Whichever has lower risk gets picked in the portfolio, or they pick on high dividend yield, or they pick on value, like whichever is underpriced, they will pick that stock, or they pick on growth prospects. So people said that there are these behaviors which have worked in the past and probably will work in the future. So I want to invest in these behaviors. And that is where factor investing was born.
Right.
So rather than investing in Nifty 100, people said create a quality portfolio out of Nifty 100. I want to invest in that. Or people said create a momentum portfolio out of Nifty 100 and invest in that. People said create a low vol portfolio and I'll invest in that. Why? They said that. So, for example, let's say Meghna, you have let's say you are risk averse in nature.
Right.
For example, you do not like too much of drawdowns or risk in your portfolio, and you said that even Nifty 100 is very risky for me. What if market tomorrow corrects by 15-20%? I cannot lose that much of money in my portfolio. So
Right.
so then there was a Nifty 100 low vol 30 created, where 30 stocks were picked from Nifty 100, which were having lowest volatility, or in the other words, lowest risk. And the portfolio was made of these 30 stocks. Even the stock weights in the portfolio were based on low volatility. Just
Right.
whichever has lower risk has higher weight.
Okay.
So here, within large cap, a low vol index was created on which an ETF or index fund is launched, where you pick 30 stocks which are less risky and higher, and the least risky stock gets highest weightage. And now Meghna says that okay, a Nifty 100 was very risky for me, but these 30 stocks which are less risky within Nifty 100, since you have created a portfolio out of that, I will invest here because this will have a lower drawdown, lower risk, because I'm picking up stocks which are exhibiting those behavior, right? Investor B, let's say me, I say that no, I believe in India's story, and I think I should invest in stocks which are doing well. I'm not concerned about volatility. I'm okay with higher risk, but give me stocks which are performing well because I believe that they will perform well in near future.
Right.
And hence a Nifty 200 Alpha 30 or Nifty 100 Alpha 30 was created, where 30 stocks are picked based on their momentum or alpha, which means that whichever has generated higher returns. The stocks which are generated higher returns recently are picked and even weighted based on that. And hence, your portfolio represents the stocks which have done well recently and will do and are expected to do well in near future. And me, I will invest in that portfolio because I want that, and I'm okay with uh, with the risk which is associated with momentum investing. Somebody else will say that no, I want to invest in a portfolio which gives me high dividend.
Right.
So here the stocks are picked based on high dividend yield, whichever company gives high dividend, and that is how if you invest in that portfolio, you get higher dividend income. And this is how factor investing evolved. So there was funds based on created based on low volatility, which means lower risk, high quality, uh, alpha momentum, dividend yield based on value, etc., with an intention to cater to different investor requirement. Some likes momentum, so don't invest in Nifty 100, Nifty 500. It's a market cap based strategy. Invest in a pure play momentum. You like low vol, invest in low vol. So this is what is factor investing all about. It is about identifying certain factors and behaviors which have worked in history, create an index or a product by picking up stocks based on those behaviors, and then invest in those stocks so that the investor who is invested in that fund gets to basically experience that behavior.
You mentioned about certain behaviors and factors, I understand. So off late, could you tell me which were the most sought after, factors in the investor community?
So in India right now, there are around 50 smart beta funds, right? ETFs and index funds. And total AUM is around 8,700 crores, out of which the most popular are, you'll be surprised, the low vol factor, which is less risky, and momentum and alpha. So two complete opposite factors are
Okay,
the most popular strategies. And I think in last 2 3 years, markets have been like that, right?
right.
Markets have been very volatile. So, for example, you had even before COVID, Indian markets, especially mid caps and small caps, were not having good times. Then you had COVID, where the entire market went for a free fall. Then you had recovery, which was stupendous. Then again, you had concerns around inflation, etc., which led to some consolidation, and then you have are having this very good bull run. So people who have lower risk appetite invested in low vol funds
Right.
because they want to have lower drawdown in their portfolio, lower correction in their portfolio, and people who like this bull run after COVID or this one, invested in alpha and momentum based fund because they're okay with higher risk, but they want that additional returns which is seeked to be generated by these fund.
Okay. So in this context, could you please elaborate on the relationship between volatility and returns in the context of, minimum volatility portfolios, and explain how this approach helps reduce overall risk for investors?
I think this question is more pertaining to low volatility based funds. So, for example, in India, there are low vol based funds where stocks are selected based on less volatility. For example, within Nifty 100, there's a Nifty 100 low vol 30 index where 30 stocks are picked based on observing their last 1 year price movement, and whichever has less volatility or less risk based on standard deviation are selected to be a part of the portfolio. Even these stocks are weighted based on volatility score, so less risky gets higher weightage. Now, typically, this fund, the way we have seen historically, have lower drawdowns. By lower drawdown, I mean that if market fell by 20%, they will fall less than 20%. So they are more stable in nature typically. And if Meghna, for example, if there are a few cycles when market is going down, etc., and you are able to, let's say, not fall by that much, and you're able to fall less, let's say 2 3 times, and then for a longer horizon, you might be able to generate excess returns,
Right.
right? By falling less, by
Right.
having less of those drawdowns. So these low volatility strategies have worked because first, they have more stability, lower drawdowns, and specifically their return to risk performance is better because they are generating return with lower risk. So that is also better. And in the long term, they can generate reasonable returns by not falling as much as market has in certain market cycles and generating reasonable returns over a long-term point of view. Whereas on the contrary, Meghna, alpha has generated higher returns than low vol historically, especially during the bull run, but it has had a higher risk or higher volatility than let's say even the market cap based indices, which
Right.
is expected.
Okay. So how successful has factor investing been globally?
So globally, it has become very successful because see, globally markets have evolved when it comes to passive investing. Like I was telling story earlier that like passive investing started with investing in market cap based indices. In US it started with S&P 500, then Nasdaq also became popular, etc. Then people started identifying these factor based indices like smart beta indices, low vol, quality, etc. And they started doing this very focused allocation to create a robust portfolio. So if you look globally, factor investing as of Feb end, there were around 1,280 ETFs having an AUM of almost $1.3 trillion.
Oh God.
Yeah, these strategies have been very popular because, as I mentioned earlier, they can be cherry picked by investor based on their investment objective or risk profile.
Okay, what approach should new investors consider when approaching factor investing?
So that's a great question, Meghna, because while I've tried to explain in as simple language as possible, factor investing is not from a behavior point of view as simple as let's say investing in a Nifty 50 or a Sensex ETF or index fund because a couple of things what investors should understand before investing in smart beta. They should first understand the factor itself. What factor works where? For example, as I mentioned, low vol works in bear market when markets are not doing well. Quality is more of a stable portfolio. It falls less during bear market. Then alpha works well during bull market or in the long run, right? A value works when there is an economic recovery which is happening, right? So there are several factors which works in different market cycles, and then there are certain factors which over a long period of time can generate higher returns also. So people should first understand behavior of different factor and which factor suits them.
Right.
Okay, so for example, a risk averse investor should not invest in a momentum portfolio, right? And secondly, after picking up the factor, they should look at what sort of products are available, and then just look at the method with which they are picking up stocks. For example, it can be different. Somebody is picking up stocks only from large cap, somebody is picking from large and mid cap. So
Right.
they will give two different. And secondly, how are stock weighted? Whether it is after picking up stocks, if you simply weigh it based on market cap, then you are again shifting your portfolio towards large cap more than towards the factor behavior, right? Whereas if it's purely weighted based on factor, then you will have not only selection based on factors but also weighing based on factors, right? And all these things affect the product performance. And lastly, very important, look at your investment objective and risk profile, and they should align with the factors. So be cautious in terms of understand the cyclicity of factors, understand how factor perform, whether the factor performance is in line with your investment objective and risk profile. And lastly, when you're sure, look at the product construct, which product construct is better and preferred by you.
Right. Okay, so how do you think, I mean, how should existing investors allocate factor investing funds within their overall portfolio?
I think they should probably start in a with a smaller quantum, because first the experience is important. Uh, that how the underlying has behaved, and once you become more and more sorts of aware about functioning of these smart beta products or factor products, then you can increase the allocation. So increase with a smaller quantum, keep it in your satellite portfolio, which is your non-core portfolio. See their performance, and if you're okay with the performance, then you can increase the allocation. Also, if you're investing in, let's say, momentum, think whether you're investing from a tactical point of view or a long-term point of view. And if from a tactical point of view, then whether the market conditions are right to have that short-term allocation, or should you go for a long-term allocation.
Okay, thanks for your insight. That is it for today. Thanks so much.
Thank you so much, Meghna, for having me here.
With this, we have come to the end of today's episode. And viewers, we hope you have enjoyed our conversation today. Please don't forget to share your comments and feedback on this episode. You can also share your suggestions and questions at editor@outlookmoney.com. We'll be back with our next edition soon. Till then, stay safe, stay invested, and keep following Outlook Money, your favorite personal finance magazine.